It's great to be joined by Riaan, Josh, and Mark here. We've got a couple of questions, and there's going to be time for Q&A at the end, so we'll do total 45 minutes or so. 30 or so we'll hopefully do the talking. But feel free to send through questions through the app, Brella, or if you haven't managed to do that, please do at the end. So I guess the first question for me, and I'm looking at Josh in the end there for this one to start with us, is how are advisors navigating hybrid models, and what has been their biggest challenge so far?
I think the challenge we've had is really, to my mind, well, when we say hybrid models, can we just sort of, what do we mean by that? Just can we frame it? Okay, so are we looking at, I think you mentioned this, knowledge sort of transferred into a machine or general use technology? What do we mean by hybrid? Because I think it means different things to different people. You've got D to XO, you've got sort of guided journeys, advised journeys, personal recommendations. You've got sort of, that sort of hybrid approach where, we're talking non-face-to-face. I see it as hybrid in that definition as technology used to advance the customer experience as opposed to technology used to just make the advisor business more efficient. I don't know if anybody else has any views on that.
I agree with that.
Okay, right, that's good. I think the challenges with it have been, I think we've heard it before, that actually we, back in 2017, we had the sort of the panacea of sort of everything was going to be automated, bionic, whatever we want to call it. We're all going to sit back and pretty much have nothing to do. And, it reminded me a bit of when sort of dot-com bubble where, there was a new economy versus the old economy. We didn't hear much of that anymore. But to my mind, we're now 7-8 years later, and a lot of the evidence, from the FCA and feedback loops is one of trust. It's one of people who have, I don't know, how can I put it, aversion to trusting technology on its own. And I think hybrid, other people have views how this came in, but hybrid is fundamentally about trust. And I think when people are making big financial decisions, not necessarily small ones, I should say in accumulation, when they're making big financial decisions, who can they call if it doesn't go the way they want? Who can they pick up the phone to if they have a problem? And I think that's, I'd say on that hybrid.
Mark, you might introduce yourself before you...
Oh, yeah. Hi, so, is it on? Hi, Mark Glover, HSBC. So I think I agree. I think there are many instances where there's very simplified investment transactions which don't really need any human touch at all. But if someone is doing something that requires a lot of funding or long-term funding or is anyway complex, and in many instances giving advice can be complex, then I think that human aspect is really reassuring. So I think designing digital experiences which have a fantastic user experience and allow some of the heavy lifting to be taken away from advisors, but also having these exit lanes where if you need to, you have the ability to speak to an advisor directly or through video chat or so on, I think is got to be the way that we can solve some of those challenges.
But one of the other challenges as well that we're trying to roboticize, for lack of a better word, old advice policies and procedures and stuff. So if you can have the best tech in the world, but if you're still taking the advice proposition of that's been going for the last 15, 20 years, and you're just trying to systemize that, you're going to spend so much money on tech, and the advisor experience, the customer experience to that isn't particularly optimal. So that's why I think hybrid is taking much longer to really become prevalent, is because organizations and policy and regulation as well. Regulation is much further behind what the technology can actually deliver. So that's, I think, one of the main challenges that we see of creating truly optimal hybrid solutions.
I'd just say another challenge is actually we talk about the cost, the capital cost to set these infrastructures up, the technology deficits that you get, the amortization of these things, the cost to maintain them. It means that really, when we talk about advice and advisory firms, we talk about the advice gap, but what about, for individuals and people, but what about the gap for advisory firms that actually it sort of sways it to the big incumbent, FTSE 100s or the companies with big pockets to be able to sort of play in this space. I think one of my challenges, and it would be to the industry, is how do we make, we're all believers that the cost of technology should come down over time. And we're talking about democratization of wealth, or what about a democratization of technology? And how do we actually be able to reuse technology, so smaller and smaller players that are just as important to servicing the general public and closing that advice gap get a chance to do that? Because otherwise we're just going to be in a position where unless you're over a certain amount of a threshold, we'll put you through this journey. If you're less than that, then best of luck. Maybe go EXO onto a platform and talk to us later.
So I think just one of the things that you mentioned there was the size of client, and I think that's a critical piece as to the size of the client, where they are on the wealth spectrum. One of the expectations I think many people had from open banking would be that you could use that to create a hybrid journey where you do a fact find on a customer without them ever being in the building, right? You take all their data and bring that through. It'll give you fantastic information to use for needs analysis. The reality that we found is that advisors, particularly at the top end, want to go through that questioning process to get to know the client. So not necessarily to give a piece of advice, but to actually make an emotional bond with the customer who might want to have for a customer for a number of years. So I think the more sophisticated and complex the needs are of the client, the more suited it is to more face-to-face. But at the bottom end, and there's a lot of people with savings in the UK now from auto-enrollment, there's a bottom end there where maybe a real advisor is not needed. And I think having effective digital tools, either from master trust providers or even from the government, right? And I think the Money Advice Service does a great job. I think they're really important to try and stitch up that bottom section of society. I think.
Yes, I agree. Workplace has a big part of this. Yeah.
Mark, just on the back of that, to what extent has technology freed up enough time for advisors to focus on client relationships?
I think if you look at the day in the life of an advisor, I think technology has played a really significant part, right from CRM systems, and that might just be the ability to do effective lead management, multi-channel appointment booking systems, the whole range of advisor office support. And I think there's been a great trend towards moving away from pure widgets of different things, whether that be a suitability letter writer or the CRM system or the commission collection system, and bringing them into one ecosystem and some really good providers. And I think that's really allowed that focus to go away from some of the sort of more administrative legwork and focus in that time on the client. But the clients have to want to do that. I think the impact of COVID, when you talk to people about hybrid outside of this room, they don't think about this at all, right? They think about people working from home. And in reality, advisors want to do that as well. And I think there's been this real shift towards having an ability to deliver advice remotely. And I think that's been a really big driver of quite a lot of increased productivity across the advisor industry.
Any add on to that, guys?
Obviously, having advised myself and slightly coming off what we're saying is pure hybrid, but I think you have this proliferation of different systems to do different jobs, widgets, and I think the integration of those widgets, and I think you could have how much time has it saved for who? Because I think the role of advisor firms and the people in them have changed. You've gone from way back an IFA with a few forms going around someone's house to then centralizing, say, paraplanners and then administrators. And I think we're sort of getting to a world now where you have this proliferation of different systems. If you look at all the different systems, whether it be DST and all sorts of plan writing software and back office systems, you've got this sort of, Scottish word coming from Edinburgh, a stramash of different 5, 6, 7 different systems. And I think if you talk to financial advisors, I think some of the hassle is the rekeying onto them and that sort of thing, and the fact that they don't talk to each other. And I think that's really that consolidation of how systems talk to each other and trying to key in once is a major time saving. So you could argue in some respects it's saved time and freed up time, but in other for advisors, but maybe they've had to take on different staff to do other types of roles as that technology latency has kicked in and they've added more systems.
Riaan, maybe a question for you to lean into here. To what extent has technology allowed wealth advisors to engage sets of larger clients?
I think in theory it has created a lot more capacity, but definitely in theory. I don't think it's really coming through in practice. So, you see some stats. The Lancat released, when they released their advice gap report a couple of months ago, there was a pretty clear graph that shows that the theoretical capacity of the number of clients that a standard advisor or an average advisor in the UK can serve has gone from something like 200 to 600 over the last 5 years. However, there's other stats out there that shows advisors see their target number of clients that they want to serve is more like 120 to 150. So there's a lot of theoretical capacity there. So I think, yes, advisors are probably serving more clients, but it's not necessarily the clients who need help the most, because at the same time you're seeing the advice gap growing. So interestingly, also NextWealth published a report just a couple of weeks ago, their advisor business benchmark report, which had an interesting stat that only 50% of surveyed advisors actually planned or had the ambition to grow the number of clients they serve. So if that's right, then it means half the advisors in the UK are happy to sit on their client banks right now. So whatever capacity they create is going to go into what Mark was just talking about having, more personal time with their clients, better emotional connection. So it's to the benefit of the clients who already get the support that they were getting anyway. The other 50% of advisors who do want to grow their business are then, but if you then look at where do they want to grow their business, they want to grow their business with lucrative clients that make a lot more financial sense to them. You're not seeing those advisors actively going into the mass market because the economics don't make sense. We're seeing there's quite significant demand from advisors to sell at very low prices the lower cohorts of their client bank. So that tells me as well they want to just focus on the higher fee paying clients. So all in all, I think the answer is no. I don't think technology has actually really resulted yet so much in fundamental shift in the market of serving materially greater number of clients. The upshot is ultimately, Josh just talked about it, is that I think it's up to the bigger organizations to really spend the capital and the money to try and crack what hybrid advice solutions for the mass market looks like, banks, pension providers, and then ultimately how can you make the economics of that work? Because even with all the technology in the world, the regulation isn't supportive necessarily or conducive to better economics, and the acquisition economics of getting those clients in to actually then serve them, even if you can make the advice economical, the acquisition economics are really hard. So I think the bigger providers need to ultimately crack this nut, and then that technology and those solutions can be democratized, as Josh said, across the wider advice market.
I think what we've seen technology do is, speaking from one of those types of organizations, is it's given us an ability to deliver information that's a little bit more personalized and relevant to the customer to allow them to do their own product discovery. And having that product discovery where a customer can utilize certain tools which aren't necessarily advice allows products to be made available which are fit for purpose for the customer and fit for purpose for the target market, but without that expensive advisor. And the reality of an advisor is that it's a very expensive piece of kit, right? To put a human in place, have a diary that's not necessarily always full all the time, have some white space in their time. It costs a lot of money. And to really make that worthwhile, the type of advice that you give needs to be necessarily complex, because necessarily complex advice creates sufficient fees to be able to sustain that advisor. So I think being able to simplify down the product offering for those who only need simple products is really the critical way of how technology can deliver to a wider mass audience.
Thanks. Maybe one more for you, Riaan, to start with. How can we enhance hybrid wealth management experiences and ensure they not come across as generic or robotic? Ironic.
I suppose speaking from M&G's context, so we've got a hybrid advice solution that we developed with Ignition Wealth to serve. So I'm going to answer this question a bit more from a mass affluent client perspective. The really important thing is, so there's a lot of technologies that journeys and digital engagement that increases personalization, but I think it can only really go that far. Our experience is you got to deploy the advisor at certain points, and as Mark says, every time you deploy an advisor, it costs you money, right? So if you understand your activity models, so you got to deploy them and design the technology and the journeys at very critical moments in the journey. And in the kind of mass affluent space, it's at the very beginning of the journey, I believe, and at the very end of the journey. So you kind of bookend the journey, because the very first conversation, Gen AI might change this over the long term, and I think we might get onto that later. But right now, that first interaction with a human advisor is really important, because as we know, all the research shows trust is the biggest impediment for someone to start engaging with this problem. A human helps them get over that first barrier. Also, from a commercial standpoint, we see the stats. If someone has spoken to an advisor first, the drop-off rate and the conversion rates are much, much higher if they've spoken to an advisor than going through a purely digital journey. So that's the first place to kind of bring the true personalization. And then at the very end of the journey, that kind of last push, there's a lot of behavioral studies which show that people kind of need the permission to act when they're trying to make what they deem to be a difficult decision. And that's again where the advisor plays a critical part, is to get them to just that last nudge to make them take the meaningful action. If you've bookended the process like that with those very valuable journeys for the client, everything in the middle you can make pretty generic. I think you can get away with that, because the client, the value that they're getting out of it is out of taking an action and getting into the process. So that's from our experience, is where you got to deploy the advisor. You got to deploy them very sparingly because of the cost element. So when you think about how you design those journeys, think about the criticality of the journey. Now, obviously, I think if you go a bit up the wealth scale, this becomes a different game, because then there's a lot more opportunity and a lot more need and expectation from the client for personal advisor time. So I explained this from a mass affluent space, but yeah, we'll see how Gen AI, that true personalization, whether people are really whether it can build the trust in the beginning, or it can give them the permission to act. I think we're still quite a long way away from that where you can replace the human entirely. But that's how I see it at the moment.
Yeah, just on your point, I think that's the getting someone over the line to actually take the decision is the bit that a lot of people go along the whole journey, drop out, and then maybe to sort of go somewhere else. And I think a lot of the studies say that about 70% of people who drop out then go and want to see a human advisor. I think the FCA did some studies on robo-advice on that. Hybrid, I think, will reduce that, but I think to Mark's point earlier, it's the triage is really important, and how that seamlessly goes from technical journeys into how natural does it feel to then engage with a human. How does it blend to that moment? At what point does the end client think, I now need to talk to someone? Do you have it sitting there so they can press on the chatbot or whatever whenever they want, or do you have a dedicated line that people call? How do you triage things out? We've built systems like this in the past whereby they've been triaged out primarily on the amount, the complexity, and then they've been almost thrown out the system to a telephone centre. And that's more about protecting the organisation's risk appetite as opposed to actually looking after, the client's needs. And it's been how that's been designed. I also think coaching, financial decisions are not about numbers. They're about choices, lifestyle, feelings, how you see yourself in the future, deferring consumption today, understanding the importance of that. And I think any sort of material along those ways that can bring out that emotional side, whether that be, your lifestyle goals, then, and there's plenty of literature out there, it's how you weave that into that journey to get into the mind of the person, understanding it's not about what can I achieve, it's what won't happen if I don't do this.
Then maybe the kind of skill sets of advisors need to change along with the technology, so that advisors start giving up control with the traditional advisor mindset of having control over everything, the product selection, the cash flow modeling, everything, has always been sat in the head of the advisor, and they had to play too many roles. They need to play more of a emotional coach type of role, and the technology just needs to be there to elevate the advisor to play that role.
I think we're seeing that model now. I think someone like Octopus Money, as we've talked about before, they are financial coaches. They're not regulated individuals, and they're largely workplace. So, you take an hour out of your day at work and you speak to a financial coach and get 3 sessions. And then at the end of that, so they've only talked to you about your goals and what you hope to do and what you've hoped to achieve. Maybe you've been challenged and maybe you've got some ideas now. But then the final bit of that journey is entirely self-directed. So there's no advisor. So the coach has just come, talked to you about, I want to retire next year because I'm bored of my job. Well, okay. Can you afford to retire? No. What do you need to do to retire? All that soft conversation before you need to buy a risk profile 4 multi-asset fund is non-regulated and can be delivered at a relatively low cost, right? So then the final bit, if it is, okay, I need to select my risk profile 4 fund and I need to invest £5,000 in it or £50 a month, then that, for me, can be robotic. And in some ways, it's better if it is robotic because you want to try and stay away from giving advice that's not based on enough information to be suitable, personal recommendation, but enough to align back with your coaching conversation with your customer. So I think there's a really emerging trend now in the UK to move away from pure advice to coaching plus an execution-only aspect at the end of it.
So coaching in some ways is a tool.
Absolutely. And I think the next iteration of that, and I think we had someone on from Schroders before, the next iteration of that is how do you use all that coaching data as training data for an AI module? And I think that's a really interesting development that we'll probably see in the next couple of years, maybe sooner.
It kind of leads us to the next question in terms of, and I suppose, Josh, I might start with you on this one. Do you foresee Gen AI being adopted to enhance hybrid advisory offerings?
Yes. I think I do. I think it's going to be iterative. I think people need to understand what it's used for, how it's used. I think there's obviously we had the Bletchley Park sort of meetings the other day, and there's a lot of fear out there, but there's also a lot of risks in the use of AI, what you use it for, inherent bias, random outputs. I think if it is going to be used, and it is being used already, we're using it in our organisation, but it's used in a very controlled manner that has thorough 4-eye checks, outputs. I think as well, the more this gets integrated, the more you're going to really have to make sure that, there's a lot of data protection issues. How do you protect the IP of any particular AI, generative AI applications that are created? And I think, but I think it will be an evolution. Ironically, we're in a revolution, but I think it will be an evolution of AI, because I think the mistakes of getting it wrong too quick. You know, the Silicon Valley is classic. You go in fast, you break things, you stand up, brush yourself off, move on. I think with AI, it's too powerful to give it ultimate control. And we look at the regulator, and the regulator has always been, you know, way back, even with risk profile scoring systems, it's like, if you do not understand what's going in, what's happening in the box, and why it's coming out the way it is, we might have an issue with you at about, you know, how appropriate is that for the consumer? How can you show that that outcome is the right outcome? So I think it will happen, but I think it's going to be, how can I put it, quarantined in a way? Well, you know, that's the way I've sort of envisaged it being approached, whereby you'd use it for maybe, we talked about this earlier, but just, you know, getting off the ground, getting something down. It's always easier to review something than it is to start from scratch. And I think it will just take initially the heavy lifting. I think it will be able to adapt stylistically to either an organization's corporate speak, but also more importantly, to individuals and the way they like to be addressed and communicated with. So, you know, we spent a lot on acquiring an outfit called Finimize, because it was bite-size, you know, to the point, condensed information without the consumer having to read huge amounts of technical information. I can foresee it being used in that fashion, but with the caveat of heavy governance, controls and oversights, especially in the beginning.
Yeah, I was going, all along the advice journey, all along except for one area, I think there's a ton of opportunity. You know, fact finds, suitability report automation, call analysis to identify vulnerable customers, you know, there's tons of opportunity. The one that I think will take the longest, if it is, because I think the regulator will take a very long time to get their heads around it, is the auditability of actual decisions made. So with our hybrid advice piece that we've got with Ignition, that's algorithmic advice, but it's very deterministic. So, you know, every single advice decision made is traced exactly to the parameter that caused that decision and the parameter before that caused that decision. And with AI, that decision generation, I think, is still a very long way off because of the need for true auditability that the regulator will put a bit of a stick in that. But I think in every other part of the journey and client interaction, there's a ton of opportunity.
So I think if you look along the wealth continuum, I think if you look at the start of personal financial management, I think there is a fantastic use case there. I mean, who wouldn't like to be told that you should cancel this Netflix subscription because you've not watched it for 6 months? And, you know, who wouldn't like to be told that you'd be better to save into a ISA instead of a general investment account? And I think there's some real strong use cases at the bottom end. I think going back to what we're saying about coaching, I think, again, that's from a, you know, when people think about generative AI and they think about, you know, sort of talking avatar, I think that coaching space is a really important area, not regulated, so not got some of the model risk. And then the ongoing servicing, I think we're, as an industry, really bad at servicing. I think we do well at selling, we do well at getting new customers in, but the servicing, unless you're getting a revenue for it, and that's a regulatory requirement in many instances to provide that service for the revenue, I think we do very bad at. So I think having that as a use case again is a good area.
Okay, we are coming up, unless there's any last comments, we might move to some Q&A. So I think we'll start with the audience here. Any hands? Take a few moments, think of questions before I ask questions. Oh, we've got one. There's a microphone coming behind you.
Thank you. It's really interesting. Could you just give me some comments around the consolidation that's happening with rapid pace in the advisor market in the UK at the moment, and what you think that could do for hybrid models. Because we talked about only big organisations being able to access this. Well, there are big organisations now being created. So I'd love to get your thoughts on the movement that's happening pretty rapidly. So whoever wants to go first.
I'll go first. You're right. There's going to be whether there's like 30 consolidators, PE-backed consolidators in the market right now. I think because most of them are PE-backed, one of the problems is the economics matter a lot. And the economics for hybrid advice and stuff, I don't think has been properly proven yet. You know, all those consolidator models and the capital that's backing it is based on basis points on AUM, and it's 150 basis points all in. You know, and it's vertically integrated. That's how those consolidator models make sense, and that's what the shareholders ultimately want to get out of it, and they want to exit in a couple of years. So that all those financial incentives aren't really pushing them to invest, because to invest for, you know, these are those kind of solutions for the future. The payback on it is way beyond the investment horizon of most of these consolidators. So I'm a bit of a cynic on that. I think they're going to be quite short-termism on the financial view, and it's again, I would say that the banks, the pension companies, and so who's got a much longer-term view who will make that investment.
I think it's a really good point, because we talk about acquiring new customers, but we don't talk about how we service massive existing client bases, and ones you acquire, orphan clients, you name it, they're everywhere, this gap. I agree with your point. I think some of the challenges we've seen in consolidation have been systems, bringing together different systems, bringing together different cultures, different advice, views on advice, and also when you have the regulatory side of it, where you have, you know, pension transfers, and you have to, you know, prove. So you need a proposition and platforms that are really that, you know, under consumer duty as well. You've got value for money, all sorts of onuses. You really do need a value proposition that you can easily help kind of put it quickly slide or put those clients through and into to monetize it, to bring those clients to a standardized type of service model. We've seen a lot of, you know, even within Aberdeen, where we've acquired lots of different types of businesses, different types of DFMs, different types of small advisors, big advisors. The after effects of that in trying to bring systematization and clients into the one domain, trying to reduce your back-end capital costs, challenging to say the least. And I think if you're going to be a consolidator, you really need to look at the book you're buying and what you currently do. And it's not the headline price of the price to earnings ratio of what you're buying. It's actually how you can monetize it after you've incorporated it. So, but I think it is a very good point. Yeah.
I'm just going to add a point. I just thought, kind of counter myself. My previous point is that a lot of the reason for the consolidation is because of advisor demographics, because, you know, the average age of advisors are 58 or something. So they're consolidating these books because these advisors are going to retire. So there's going to be a cliff edge where to actually look after all these clients, you're going to need hybrid technology, because all the advisors that's consolidated are out of the industry, but the clients are still there. So kind of, yeah, the financial incentives would be to not invest for the future, but at the same time, it's also you have to, because otherwise you're not going to be able to service those revenue streams you bought.
I think one of the things that consolidation does do, it drives a centralized investment process, and mostly trying to get advisors to work from a common advice policy is not an easy thing. The other thing that it does is it creates a bit more buying clout with providers. So I think, you know, there's a lot of technology providers now who are able to provide a good end-to-end solution, including hybrid functionality, quite turnkey. And I think having that real buying clout makes a big difference.
yeah, it's a large numbers, low volume game or low margin game. But I think that's especially the case that we've seen in Australia. And I'll bring in regulation here again. I keep harping on about it, but we see in Australia where they were well ahead. If you look through, from a superannuation perspective, decades ahead of the UK, and that environment became so onerous for advisors of best advice. That actually the risks the organisations were running and the amount of education, not that you needed a PhD to advise someone, but it's got to the point where it's just not worth it for advisors. So you've seen a huge drop off. I think in Australia's over the last 3 years, it's gone from 25,000 to like 13,000 advisors now, and you've got buyers of last resort like AMP, desperately sort of going, or we're going to have to take on all these books, and hence, obviously the Royal Commission and hopefully ideally the change in legislation that really goes a bit towards what we are in the UK, where you have a bit more delineation between guidance, advice. I mean, we obviously went for simplified advice here with ISAs, and that was sort of kicked down the road, and hopefully there's the various discussions here at the moment with being really clear about where one hands off to the other. I think in Australia, yeah, it will go that way, but in the meanwhile, what you're finding is a real reticence of companies, and this is especially in the robo place where the regulator was coming down quite a bit on those sort of robo practices, primarily because they were shoehorning people into their own products and basically doing the vertical integration, but not necessarily maybe always in the client's best interest, but to monetize this stuff, where you've had the opposite took effect. So trying to implement sort of robo in Australia has been problematic due to the fact that the intermediary firms, and quite large ones, are not prepared to necessarily take the regulatory risk with it. The other side I'd say on that is that we work in data and numbers with robo, but a lot of insurance policies associated with superannuation plans don't necessarily have data attached to every clause that you can easily scan through a system. So it's about data provision. But so probably rambling on there.
That's okay. We've probably got time for one more question from the audience.
Hi. Thanks. The discussion's been really, really interesting. I'm co-founder of a business called Ammonite, and we're developing hybrid advice technology. In relation to the actual role of the advisor, do you see there being a segmentation in terms of the actual aspects of their job moving forwards, and clear departments within organisations where they're ultimately doing a remote online role? So, for example, you talked about coaching and triage and those sorts of things. The advisor actually maybe not getting involved in certain parts of the process, and having very clear specific roles with technology aligned to those roles?
I think yes. So yes is the answer. I think what we've seen really through the growth of the financial planning industry is the role of the paraplanner. So most people be familiar with the role of the paraplanner. Basically, they do all the legwork, right? And they reach out to the client and they get the necessary documentation and they fill in any gaps, and then the financial planner or the advisor will come in and swoop in and give the advice and do all the detailed stuff. Now, the role of the paraplanner, I think, is something that's entirely digital. Could be, really, really could be. But in reality, a lot of financial planning firms will tell you the role of the paraplanner is critical to building a relationship. So yes, I think it is possible to digitize those bits and pieces, but that human touch really makes a big difference. But I'll go back to something I said before, and that really depends on the size of the client and the sophistication of the advice that's being given. Because if that client's only got £15,000 to invest full stop, then it's a very different one to someone who's got 500,000. And I think that's a really important piece, is that if your entire world of solutions is a protection contract, maybe a term product, a pension product of some sort or another, an ISA and a general investment advice, by and large, you're going to have relatively straightforward advice. But if you start going away from that to more complex things, pension consolidation, DBDC, all that sort of stuff, then that's where those roles need to be really clearly segmented, because the needs, and sometimes, quite frankly, the depth of the analysis to give suitable advice changes considerably. That'd be my thought.
Yeah, I agree. And something that we're also seeing is, if you don't have a very mature technology stack where some of these different things are happening, like you might be using for the protection business, you've got a hybrid journey built in this system, and for the consolidation stuff, you're using that system. All of a sudden, the advisors now have all this great tech, but they're spending half their time moving now from one system to that system and to that system. So if you've got an employed advice force, all of a sudden that becomes a very inefficient system to model. So then you start doing things like, okay, these advisors purely focus on new business. So the skill set, what they need to do is a bit more sales focused and a bit more getting the conversion focused. And then there's others who do more ongoing servicing and stuff, which is also not great for the client because they don't have a consistent relationship. So I think until you get to a point where you've got critical mass of journeys and products and interactions on one consistent tech stack, you're kind of going to have a bit of a fragmented advisor skill set that plays into different parts.
Yeah, I'll just follow up on that. I think actually that's a natural evolution of what we've been talking about, the cost of technology. So we heard earlier, it's like if you want to sort of monetize this, you've got to be really clear about your target audience, your client segment, exactly what you're building for that to be able to do it as sort of, how can I put it, as cheaply as possible, as risk-free as possible, and get as maximum bang for your buck. But then what that creates is one journey for that type of customer, another different type of journey for that, another different one for that. And I think it's as much about the customer knowing where they are on those digital journeys and why they're there is as important as it sort of from the customer perspective looking in, as much as from the advisor. As an industry, we're very good at talking about ourselves as, you know, talking about advisors, asset managers, platforms, but what's the customer seeing? So if the customer knows that you're going down this journey because of this reason and that reason, and this is the most effective, and in the future, when you get to these trigger points, you will be engaging with you in a different way, then they can see actually as they go through their life stage or their needs become more complex, that you keep that loyalty and that understanding of what the client's getting as a service level or not getting as a service level and why. And I think there's a whole challenge here of bringing in those different journeys together, because at the moment there is no real system that does holistic financial planning. It's all just, if you want an insurance protection journey, go down there. If you want another journey, go down there. And the clients are just sort of, they're just jumping about throughout the life stages of their. So are they actually loyal to the tech, or actually are they loyal to the advisor firm? And I think the more they can know where they are in that overall digital journey and the reasons why and what happens next, I think that's hopefully how we can evolve.
Thank you.
Thank you, Josh. And I think we're going to go and wrap it up. Thank you, first panelists, and to the audience for the questions. I think we'll all be around for a little while. Obviously, Josh Fennell, Global Head of Wealth Solutions at Aberdeen. Riaan de Bruyn, MD for Digital Wealth at M&G. Mark Glover, Global Head of Financial Planning for HSBC. So happy to take questions after the event. Thank you.
Thank you very much.